Bitcoin has nearly doubled in the last 90 days. Hey guys, what's going on? Jeb here, and in today's video, we are going to be talking about how Bitcoin has rallied more in the last 90 days than it did in the entirety of the 2016 and 17 bull market, and we're going to be asking one very important question. Since Bitcoin is rallying so quickly, when will it actually hit all-time high? Everything from our historical analysis, to the upcoming pause to the Fed interest rates, to the Bitcoin halving clock continuing to click down. These are all of the reasons why I think that an all-time high run on Bitcoin could be sooner than we expected. So without much further ado, let's go ahead and dive right on into it. Today's video is brought to you by our very own Cryptocurrency Technical Analysis Academy. This is the one-stop shop for all cryptocurrency traders and investors to learn technical analysis so that you can begin profiting in these markets. Over the course of over 45 videos and counting and over 10 hours of content, I'm going to teach you everything that you need to know based on my 6 years of experience in technical analysis, about technical analysis, so that you can apply it to your trading and your investing and you can actually start to make money in these markets. We've helped over 5,000 students learn how to do technical analysis, and I want to help you next. You see, I believe an investment in your education is the single greatest investment that you will ever make. So if you're not already signed up for CT2A, make sure to do so at the link in the description box down below. Bitcoin has been experiencing an explosive rally here in the back half of 2023, and that has had a lot to do with the announcement of a BlackRock ETF back in June of this year. Ever since that announcement came, and especially ever since Cointelegraph announced that the BlackRock ETF was approved, which was fake news, Bitcoin has been going through a massive bull market. And even in just the last couple of days, that rally has picked up, bringing Bitcoin all the way from $41,500 to its current local high at $45,000 on the back of news that BlackRock has received $100,000 in seed funding for their spot Bitcoin ETF. On October 27th, back when Bitcoin was in the midst of recovering from its previous massive nearly $10,000 rally, an unknown and mysterious seed investor agreed to purchase $100,000 worth of shares of the Bitcoin BlackRock ETF. And on October 27th, 2023, they since took delivery of those 4,000 shares at a share price of $25. The fact that the SEC is allowing anybody to take delivery of shares of the Bitcoin BlackRock ETF is a great sign. And need I remind you that this was nearly 45 days ago and things have only progressed since then. But speaking of back then, today we're going to start off with some historical analysis. You see, the backbone of technical analysis is historical analysis, looking at what the price has done in the past, finding and discerning trends that we can then use to predict future performance. And today we're going to look at 2019 and 2020 through the lens of historical analysis to gain some perspective of when we will be rallying back to all-time high this bull market. Because those are really about the only two time periods where we have seen anything akin to the kind of rally that we are witnessing right now. To put this recent rally into perspective, we have rallied as far in the last 90 days as we did in the entirety of the 2016-17 bull market, and we're not even getting started yet. The most recent examples of analogous markets would be the rally from $10,000 all the way up to $70,000 back in 2021 that led into the bull market and to our first all-time high at 65K. Before that, our next analogous historical price action that looks anything like what we've just experienced was this rally in the first half of 2019, where we rallied $10,000 in 150 days. And there are multiple similarities and differences between these two markets. This first rally here in 2019 rallied over $10,000 and Bitcoin would stop at $13,500. At the time, that was a rally back to the 0.786 retracement level on Fibonacci, which was right around where we rallied to at 13,800. This 2019 rally was initially kicked off by a reversal in the histogram on the MACD, which ended up turning into a cross just a few months later, and of course a bottoming out on RSI, which ended up turning into a cross above the 14 interval moving average just a few months later as well. These were early signs that Bitcoin was going through a massive reversal on its monthly chart from bear market into bull market. We are seeing many of the exact same signs right here. Denoted in red, you can see the reversal of the histogram on MACD followed by a bullish cross, exactly the same way that we saw in 2019. At the same time, denoted in blue here, you can see where the RSI bottomed out, and then just a couple of months later, where RSI broke above the 14 interval moving average, even coming down and back testing it as support just a few months ago before this massive rally began. In short, our market right now is looking very much similar to the market that we saw in 2019 that topped out at 13.8, did not rally to all-time high, but would end up leading us to all-time high about a year and a half later. There is one key difference that we're going to talk about here in just a moment, though, and that would be the halving. This rally and all of its subsequent signals happened a year before the halving, denoted here in white, in May of 2020. Our halving is in April, just 130 days away. So it is important to note that all of these trends are happening significantly closer to the halving, indicating that we might not stop out at the 0.786 level, which currently sits at $50,000, but we may actually continue going all the way back to all-time high. The fact that we are going through these same rallies with these same signals coming from the same indicators, MACD, RSI, volume, and more that I could go into, we could be here for hours talking about the other indicators, lead me to the conclusion that what we're experiencing right now is a rally very similar to this beginning rally of 2019, but instead of seeing a year of sideways price action before we actually break all-time high, we might only see a very short correction, which would lead us to all-time high much sooner. In the 2019 example, we had the pandemic begin, and then at the very beginning of 2020, Bitcoin would drop 60%, putting a massive damper on the entire rally to start with. And we also did not have a BlackRock ETF to consider, which, by the way, we are likely going to be seeing an approval for, if we're going to see an approval, in Q1 of this coming year. Based on my technical analysis, my thesis is that we're going through a market very similar to what we saw here, where Bitcoin rallied 300% in the span of just 4 months. But instead of going through a year of sideways price action the way we did in the back half of 2019 and the beginning of 2020, we may very well just kind of jump forward 6 months towards this all-time high run territory and beyond much sooner, maybe Q1 of next year. My initial prediction for a return to all-time high on Bitcoin was Q3 of this coming year, but there are 3 major reasons besides the technical analysis I just showed you that Bitcoin may be rallying back to all-time high many months sooner than that, potentially even as soon as January or February of this year. I've already told you one of them. That would be the BlackRock ETF, and that is coming very soon, either an approval or a denial. Probably going to be an approval, considering they're already selling shares of it. But there are 2 more reasons why I believe an all-time high run may be coming even sooner than Q3 of next year, which was our initial prediction, and I'm going to explain those now. First and foremost, the Bitcoin halving. As aforementioned, the Bitcoin halving is only 132 days away, and it is expected to happen on April 17th, 2024. The Bitcoin halving occurs roughly every 4 years, and it results in a halving of the block reward for miners. Now, the way that Bitcoin works is via blockchain. It is essentially a long ledger of different containers of transactions linked together in a chain. And to create one of those blocks, you have to have a miner mine the block. Well, the miner has to make money for the work that they put in, and so they get paid in 2 different ways. Number 1, the fees that you pay on the Bitcoin transactions that go in the block that they mined, but also via the block reward. The block reward is currently 6.25 Bitcoin per block. Yes, that is a lot, but it will be cut in half on April 17th down to 3.125. That means that the inflation rate of Bitcoin will slow down by half, making it even more scarce. Bitcoin is already more scarce than gold, i.e. it is increasing in total supply slower than gold, but it's going to be increasing in its total supply at half the rate in just 4 months, giving a supply side shock. At the same time, we're seeing a demand side shock with the BlackRock ETF probably coming. This is a perfect storm of bullishness, because when you see the supply get cut in half and the demand double, triple, or quadruple, naturally the price is going to go parabolic, and that's why we're looking at a January to February all-time high instead of Q3, because the halving's coming up at the very beginning of Q2, and the hype for the halving normally takes place right before the halving and right post-halving, and of course there's the BlackRock factor to consider. Looking on the charts here, during the last halving, which was in May of 2020, we did see a massive run up to the halving. Bitcoin doubled in less than 60 days, and if not for the pandemic having crashed Bitcoin 60% in the span of just a couple of days, we probably would have seen Bitcoin go through a very similar rally up to nearly all-time high before the halving even kicked in, and we may have seen the all-time high run up to 30, 40, 50, 60 several months earlier, again, if not for the pandemic. And so too, we may see the exact same thing occurring this bull market as a result of the halving. Last but not least, we also need to talk about the Fed rates. The reason the Fed rates are so important is because the effective federal funds rate is the single number that drives pretty much the entire market. A brief history of the Fed is as follows. The 12 decentralized Federal Reserve banks were set up in the very beginning of the last century following a huge number of banking crises, and they were designed to be a lender of last resort. Essentially, banks work by loaning out the money that you deposit to generate interest, and that's where they make their money from. But they typically, back in the day and even today, only hold on to 10 to 20% of your money. So if everybody tries to withdraw at the same time, they can go bankrupt. Where the word comes from. The large number of banking failures led the government to realize we need some kind of fallback so that people are not losing all of their deposits, because this is causing a recession every few years and absolutely stifling the growth of the national economy. So the Fed banks were created as a lender of last resort. In the 30s, as a result of the Depression, the centralized Federal Reserve was created over the other 12 Fed banks, and they have 2 major tools at their disposal to manipulate the economy, that being their interest rates and that being their balance sheet. The balance sheet is a topic for another video that we've covered before, but the effective federal funds rate is important because that is the rate of interest that they charge on the loans that they hand out to those banks. Remember, the banks come and borrow money from the Fed. What rate are they charging for that money that they lend out? That is the effective federal funds rate. Over the course of the 21st century, the effective federal funds rate has basically been zero. Essentially, especially during the 2010s, if you wanted to borrow money from the Fed, you basically got it for free. But there have been a few examples of hiking interest rates from the Fed in an attempt to slow down growth in the economy and normalize inflation. The first hiking cycle happened in the lead up to the 2008 financial crisis, and the last hiking cycle happened in the lead up to the 2019-2020 recession caused by the pandemic. As a result of all of the inflation that the Fed caused trying to fix the joblessness that was occurring from the pandemic, they've hiked interest rates at the fastest rate that they've done in decades. And for the last year, everybody's been looking at one word: plateau. When do the interest rates stop hiking? Because as we're about to see from the history, when they stop hiking, generally, they start to go down very soon. In 2006, when the effective federal funds rate plateaued, it only stayed at plateau for 420 days before it slammed straight down to the floor back to zero. Here in 2019, we were only plateaued for less than a year before they were slammed right back down to the floor at 0%. And the reason that's so important is because the United States economy is driven on debt. If you're trying to expand your business, you're probably borrowing money. Well, every single interest rate in the entire world, not just the United States market, but in the entire world, is based off of the effective federal funds rate. So if the effective federal funds rate is at 5%, you can basically guarantee that you're never getting less than a 5% interest on any loan that you take out. So when that goes down to zero, all of your interest rates on all debt that you can take out goes down by at least 5%, because the banks are trying to make the difference between the effective federal funds rate and what they're charging, because if you go back far enough, they're eventually borrowing from the Fed. So they have to arbitrage and make up the difference. That's why credit cards are 26.99%. Please don't get into credit card debt. That's why home loans are 8-9% right now, because the effective federal funds rate is so high. On a home loan, the difference between a 3% interest rate and a 9% interest rate could be the difference in thousands of dollars a month in payment. So you slow down the economy by hiking the interest rates, which means you speed up the economy and you speed up the investment in new expansion of the economy, therefore leading to expansion in the stock market and into cryptocurrency when you drop the interest rates. Well, the effective federal funds rate has already been plateaued since July. We have not seen another hike yet, and if we don't see a rate hike on the next decision, which is coming in 7 days, then we will basically be able to confirm that a Fed rate pause has now occurred, and within the next 12 months, we should be seeing the rates drop. But you start to build the hype about rates dropping as soon as you realize the plateau comes, because to get to a rate drop, you first have to stop hiking the rates at the first place. And CME Group, one of the most powerful financial organizations on the entire planet, give it a 97.7% likelihood that the Fed rate will be paused once again. Again, meaning that we will probably see a Fed rate drop at some point in the next year. But that meeting is coming up in 7 days on December the 13th. And when the market realizes, wait a minute, the Fed has actually paused interest rates and they're probably not going up again at all, that will be massive fuel for a bullish movement on the stock market and also on Bitcoin, which contributes to our Bitcoin prediction. And that's how all of this comes full circle. As I've stated, there have been two major thought processes of when Bitcoin is going to hit all-time high, either Q3 for multiple reasons of next year or Q1 of this year, January, February, March. And those are the three reasons why I am actually leaning in the direction that an all-time high run on Bitcoin could be coming a lot sooner. I do like to remind you that anything can happen. The BlackRock ETF could be denied. The Fed could come out of left field and they could hike the interest rates again, throwing out the idea that we're going to see a Fed rate pause and throwing out the bullishness with that as well. And of course, there is the opportunity that, look, Bitcoin's already rallied $20,000. It's going to stop out at 50, which is our 0.786 level, go through a correction for several months, and then go to all-time high in Q3. That can still happen. But right now, the fact that Bitcoin rallied straight through 41K up to 45 gives us a lot more indication that the magnetism of all-time high might just suck us right up there immediately. So when are we going back to all-time high on Bitcoin? Honestly, I'm starting to lean in the direction of January, February, and March of next year. Hopefully you see all of the reasons why I'm starting to lean in the direction that an all-time high run coming in the next several months is right around the corner. If BlackRock's ETF does get approved, I think you're going straight to all-time high. If it gets denied, you're probably going to go through a major correction and then rally to all-time high in Q3. As we talked about, it's not uncommon for Bitcoin to hit all-time high a couple of months after halving, which would put that all-time high run in summer to early fall of next year. Regardless, I have an over 90% confidence that we're going to all-time high on Bitcoin next year. Many of your favorite altcoins are going to as well. So I want to just kind of let you know right now what you need to do. You need to ensure that you are building your dollar cost averaging portfolio right now. And the way that I recommend doing that is investing every single Friday, whatever you can afford to lose, in about the top 20 cryptocurrencies. Start with a lot of it in Bitcoin, a little bit less in Ethereum, and then invest in ADA, Solana, XRP, Binance, Dogecoin, Sheev, Chainlink, Polkadot, all of those cryptocurrencies, top 20. I personally exclude Litecoin and Bitcoin Cash because I don't think they're going to be very successful this bull market, but pretty much the rest of them, stablecoins notwithstanding, that's what we're doing. We're dollar cost averaging into those. If you have not already set up that investment portfolio, I would highly recommend you do that with whatever you can afford to lose every single Friday over on Coinbase. And also don't forget that to be successful in the cryptocurrency markets, you've got to have an understanding of technical analysis, so make sure to check out the Cryptocurrency Technical Analysis Academy with the link in the description box down below and get access to over 45 videos and 10 hours of training teaching you how to be an expert technical analyst and join 5,000 students who are investing and trading profitably in this market every single day. If you enjoyed today's video, make sure to hit that like button, subscribe to the channel, and share this video with somebody that you think would find value from it. But before I go, I do just first want to thank each and every single last one of you for watching, as always, and I will see you guys in the next video. Peace.
Oh, I got a real good feeling.